Howdy, Jacob here. Today we're looking at Spire. Three more companies to look at in our dividend yield screener. Getting pretty close to the new one. Very exciting. So Spire is in the gas utilities industry. 3.2 billion market cap on 6.4 billion enterprise value. A lot of net debt here. A little bit of growth. 1.6 billion in revenue in 2014 to 2.7 billion in 2023. Heavy growth though in 21 and 23. Outside that, it's been relatively flat. Margins, both are up quite a bit. Gross margin from 22.2% to 33.3% after in 2023. And then 10 years ago, 10% operating margin up to 16%. Return on invested capital, low single digits. Makes sense that they're paying a dividend. Their dividend has gone up at least 4% a year every year for the last 10 years. That's pretty impressive. 5.2% dividend yield. Let's look at that debt, though. I was a little concerned about that. Ooh, this might be bad. $6 million cash on hand, 3.5 billion long-term debt, 1.1 billion short-term debt. Ooh, this is going to be bad. So 4.6 billion essentially net, and they don't produce. Okay. Well, I should just really look at the cash flow statement first, honestly. I don't know why I don't do that. I feel like I do myself into thinking, oh my gosh, so many things look great, and then they don't produce cash flow, so it's an immediate turnoff for me. They have not produced positive free cash flow since 2016. And so classic utilities company where cash from operations increases due to, just revenue going up and net income going up, but then their capital expenditures due to growth are getting so much bigger, it expands faster than their cash from operations. And so looks like they fund a little bit through issuing debt and a little bit through issuing shares to fund their losses. And so it looks like they don't do anything with their cash except for, well, they don't make cash, but with their loss free cash flow, issuing shares, issuing debt, they just pay a dividend. So doesn't look like there's too many investments or acquisitions, I should say. So yeah, let's just cut it. Let's do some assumptions. 3% revenue growth, 13p in price free cash flow. Let's say 7%, 2% share, like maybe 1%. They can't afford this dividend. So it's all fugazi, make-believe, fairy dust. Doesn't exist. You don't produce cash flow, I don't like you. Simple as that. So quick video. Hopefully everyone enjoys the rest of their day. Thank you.